everyone, I'm Caroline Zakarian, and I work in the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to Financial Literacy Month. Today's presentation is called Being a Smart Investor, and it's brought to you by the Financial Planning Association of Los Angeles and the Los Angeles Public Library. Today, Jamie Rugg from the FPA will talk to you about investing and investment concepts. And she's going to explain how investing fits into her overall financial plan, introduce general investment strategies, and discuss ways to put these strategies into action. She will also show how discipline plays a key role in being a successful long-term investor. We will have a brief Q&A after the presentation, so please send us your questions throughout the program. Thank you. Take it away, Jamie.
Great. Thank you. Good afternoon, everybody. Thank you for having me. Excited to go over some investing fundamentals and how to be a smart investor in our presentation this month. So before we kick things off, one thing we want to be sure to discuss and cover with everybody is we're going to talk about investing and investing concepts, how investing fits into your overall financial plan, introduce some investment strategies, talk a bit about market volatility that we've been seeing the last few weeks here in the stock markets, and also discuss ways to put some of these strategies into action. As Caroline mentioned at the start there, the chat is certainly open. We will be making time to answer whatever questions you have at the end of the presentation. So please feel welcome to add those in as we go along, and we'll get to them at the end of our conversation. So what we're not going to do today, though, we're not going to help you become a stock picker, provide any sort of insider information, or recommend a specific course of action for you. All the information today we're going to be sharing is somewhat general in nature, but we really want you to think about your specific situation, your goals, your time horizon, as well as a couple other concepts we're going to get into today for you to frame how, if you're appropriately invested now, or if you want to start getting invested, how to think about going about it in a way that's going to be sustainable for you for the long run. And so, apologies, it's a little hard to see the colors, but what financial planning is, and I am a certified financial planner, and a member of FPA, the Financial Planning Association of Los Angeles chapter. And really, when we talk about financial planning, so there's so many different concepts and words for the whole wealth management, advising, financial world. Financial planning is really that comprehensive and what we consider systematic approach to getting all of your financial house in order. And that covers investments, of course, tax planning, insurance and risk planning. So looking at what other risks you might have out there. Your company benefit plans, how do we make sure we're maximizing for the future, whether it's your own company or you're an employee. Also retirement planning and estate planning as well. How do we think about passing on our assets, and what are our wishes? What do we want our end of life experiences to be? So today we're going to really focus on investment planning and how we think about being a smart investor. So the key concepts we're going to cover, we are going to talk a bit about asset allocation, diversification, risk and return. Some of you may be very familiar with these concepts, others may not be, but we'll take a moment to introduce each one of them and explain why it's important to consider when you're thinking about your overall financial strategy. And before we move on to some more of the detailed information, I do really want to emphasize, and as a certified financial planner, we really want to emphasize how important it is that your investments and are really matching up with what your goals are, what you want your life to be, what you want your life to experience. We believe money is really a means to an end, and that's to help you experience the life you want. So that also means making sure you have the right allocations, not taking on too much risk, having the right exposures, but really thinking about each of these different pieces to set yourself up for success for the future. So what are the reasons to save and invest, right? We always hear we should be saving as much as we can, we should be investing that money, but what are kind of the key goals that most people have, whether it's for saving or for investing? These are pretty straightforward and pretty simple, but for savings really come into play for things like emergencies, vacations, short-term goals, as we see on the slide here, whereas investing is focused on longer-term goals, longer-term periods of time. So whether that's saving for a child's college, saving for potentially a home and something we want to build some money towards, or really when we think about investing, we think about kind of retirement planning and making sure we have enough funds to live the kind of life that we want to live in retirement. So from the saving side, we think of that usually in the few months to a year or two's worth of savings, and kind of a lot of things longer term than a year or two we really want to think about potentially investing those funds so we can take advantage of having our money in the market and taking advantage of the power of compounding, which we'll go into in just a bit. And I would be remiss without mentioning before we move on, when we think about saving for emergencies, at a minimum, kind of the standard is we want to have at least 2 to 3 months worth of expenses readily available in our savings account. So that's, if we think about our rent, or mortgage payments, auto insurance bills, homeowners policy or renters policies, groceries, any credit card bills, any of those fixed expenses that we can't miss or can't skip. Think about that number and multiply that by 2 or 3 if you're still working, if you're in your working years. And if you're in retirement, oftentimes we think of that number as 6 months to maybe even a year's worth of something that's pretty liquid, very reliable. It's not taking on really much risk. So that's money is going to be available for us if and when we need to pull it out. But for longer term goals, things that can be, again, the number is different for everybody, whether it's from 2 years out or 5 years out or so on. That's when we want to think about investing those funds. So again, we can take advantage of that money being in the market and appreciate and grow what that can turn into down the line. So when we think about savings, again, we're really talking about putting money into a savings account at your bank or a money market account, hopefully something that is earning some regular interest. If you have a lot more in savings, hopefully it's in something that's in a high yield savings account. Most banks do have those. Sometimes they do have bottom limits to their dollar amounts you have to have in order to access that account, but they can be earning anywhere from 3.5% to 4+% with where interest rates have been lately, so that your money's not just sitting directly in cash, it's actually still earning a little bit more than inflation. Also, the money, again, it's immediately accessible if you need it. Those assets are safe. They are FDIC insured up to $250,000 in each one of those accounts if it's through U.S. bank or credit union. So that's really what we think about when we think about savings. So we're going to set that aside for the rest. So we know we have a couple of months of expenses, and then we can focus on some of our longer term goals and longer term investing. And if you're getting started right now and you don't quite have that emergency fund or the couple of months worth of expenses, take in the information we're talking about today. But the first priority, the first order of action is actually going to be for you to set aside that money in savings. So you have a cushion to fall back on if something were to happen, like the markets are in a turmoil, there's a health event, or maybe there's a job loss. So even if there's nothing else, that's the first step. When we think about investing, we're really purchasing other assets because we believe that they have the potential to increase in value. Maybe they're going to provide us income or dividends, or it could be both. But we all know, for the most part, we do expect that what that return is going to be, none of us can perfectly predict what that number is going to be at the end of the year or the end of 10 years. So expect fluctuations in what the actual returns are going to be on any given year. And then if you do need to sell because you don't have other cash, or you don't have that emergency savings, you're going to sell at whatever price the market is giving you at that time. Part of the reason why having that emergency savings is so crucial, if there is a job loss or something happens, we want you to be able to ride through any sort of period of what we consider acute distress, or any sort of job loss, or something happens financially. We want you to be able to have enough to get you through that period of time so that you don't have to pull your money out of potentially the markets or your investments when it might be an inopportune time, when the market might be down or in correction territory. And then also, we all need to recognize too that there isn't a guarantee in investing. This is not backed by the federal government if we choose the wrong investments. So there is a potential for losing some of that money since those assets are not insured. So it's just another thing to think about. It's not necessarily the same thing as gambling, but people do make that analogy because it's not a guarantee. We don't have a guarantee on what's going to happen to those funds. So before you invest, just to kind of recap, get a handle on your cash flow. Take a look at your monthly income, what's flowing out, those monthly expenses. Build that emergency cash, that emergency fund or that rainy day fund. If you have really high credit card rates, or there's a lot of debt that's been stressful or sitting in the back there, try to start to pay off some of that high interest debt. And kind of a blanket way to think about it is, if your credit card rate is 20+%, and you think maybe the market's going to earn 6.5% to 7% in a year, you're actually better off financially trying to put more money towards paying down that debt first before you just build up the investment account, but you're still paying 20+%. So if you think you're going to earn, and whether it's a property, a mortgage payment, a student loan, if you're going to be paying more interest than you expect to earn in the markets, that's when you'd want to consider, if you do have excess resources at the end of the month, putting more of that money into paying down that debt, but still starting to get in the habit of saving and investing for the long run as well. And then think about buying the right kinds of insurance. So we don't go into much on insurance in this conversation today, but the right kinds of insurance. If you don't have a need for it, or there isn't a large risk that you're not willing to bear, sometimes insurance is not the right move. But things like, of course, auto insurance, having a homeowner's policy, all of that is important to make sure you have that covered, the right amount of coverage before you would be considering investing. And then also naturally make sure that you do have a will. If you do have assets, whether it's real estate, personal property like cars, vehicles, investment accounts, make sure you've specified who you would want to receive those assets in the event of something happening to you. Make sure it's just written down somewhere. We have had other conversations and webinars on estate planning in the past. I'm sure we'll do some again in the future. If you'd like to learn more about that, please do let us know so we can create one of those down the line. So when we think about investing, first and foremost, kind of the low-hanging fruit is if you have an employee-sponsored retirement plan at work, if you're eligible for it, and especially if they provide any sort of match, whether it's 2% or 3%, depending on how much you contribute, that's kind of considered, can be almost free money waiting for you there. So first and foremost, participate in your employer-sponsored retirement plan. And not only just that, they are tax-advantaged accounts. So there's actually a kind of a tax benefit for using those funds so you can save and invest for the long run. Consider opening up an individual retirement account if you have excess monies left over and you have been contributing to your company retirement plan. Also consider contributing to a college savings account if you do have a minor or a child, or maybe yourself who might want to go back to school. And then the fourth one on the list is really investing in those taxable accounts, what we consider a brokerage account that you'd open up with a large banking institution. Then that's where you would invest the money directly. Just like with anything else, when it comes to financial planning, we want to think about also having an investment plan, an investment strategy before we get started. You don't have to have every single thing figured out, but it's important to map out, when you think about the future, what are my goals? Maybe it's I want to save up and start investing some money, but I want to be able to buy a house in a few years, but I also want to start saving for retirement because I know I've heard it's important to do. Or maybe it's, I'm 5 years out from retiring. I really want to try to maximize the window I have before I will be in retirement and maybe starting to use those funds. So identify your goals and actually write them out on a piece of paper as well as a time horizon. And you can't have different goals with different time horizons because maybe, I need to buy a new car in the next couple of years. I also want to make sure to set aside this money for maybe it's college for a child, but I also need to make sure I'm also saving for retirement. Each one of those has a different time horizon depending on when you need those funds to be available. Of course, we want to think about balancing risk and return. In the last few years, we've certainly seen certain types of assets that have very much quadrupled plus even more in price. And that's been in a lot of the headlines. But oftentimes some of those investments, assets, or securities that are really high performing also can take on more risk. It doesn't mean anything is inherently right or wrong. It's just a matter of understanding your risk tolerance, what your expectations are for their returns, also knowing it's not a guarantee. But the key word there is balancing the risk and the return expectations with what feels appropriate for you. So this is all kind of goes into that, creating that investment strategy and thinking about doing your research to select investments that are appropriate for how much risk you're willing to bear, as well as a time horizon. Because the last thing we want is for your money to be in something that is a really high-flying stock or security that can be really, really volatile. But if you need that money to be stably there for a down payment or something else in a few years, we don't want it to be subject to that much potential volatility and risk. We need that money to be more predictable. So that would point to something that should be a little bit more conservatively invested. And then, of course, with anything else, like any good plan, you want to monitor and update your plan. You want to monitor and update your portfolio over time. It's certainly as things change in your life, your family situation changes, your income changes, your preference changes or life events happen or whatever the case might be, make sure to be revisiting it, checking in on your portfolio at least a couple times a year, but revisiting your plan every so often as well to make sure it still matches with how you originally built it to be. So we feel a little bit more on that risk and return. So risk, when we talk about risk in investing, just like, it's a little bit different than we use in the real world to some extent. So risk is the possibility that you could lose some of the money you invest. Again, the greater the risk of the type of investment you're purchasing, the greater the potential for a larger return, but you could also get a much larger loss depending on how that actual investment does. So it's understanding, this might feel like a great investment, but do I understand that this could actually go down a lot more than something else that's a little bit more stable? And then return, again, is what you would get back as percentage of the amount that you do invest. If you do limit your risk too much, again, using relative terms too much or much in this example, because it all is all relative to your preferences. But if you limit that risk too much, you actually might limit your potential return as well as a potential loss. You might not earn as much, but you might not lose as much. So it's kind of, again, a balance of mixing in the right types of investments to balance the risk, but also the return. And that doesn't mean you have to be in one particular investment. It's in a grouping of investments, so it's diversified. So a bit more about understanding your risk tolerance. I think sometimes we toss out these terms and it's not as obvious what this really means. There are certainly a lot of quizzes you can find online to try to evaluate your risk tolerance. Just be mindful if you do some of those quizzes online, it might push you to try to speak to an advertisement, to speak to an advisor, open up some sort of account. So just be mindful of that if you do go through any of that online. But there's really good information that you can find available on the internet these days. So understanding your risk tolerance. I want everyone here that's listening in or watching this after to think about these questions and yes or no answers, really. So ask yourself, are you willing to lose some principal in pursuit of higher returns? Yes or no? Are you willing to basically take on a little bit of risk so that the ultimate goal is you might actually get a higher return as a result? Are you comfortable with that scenario? Do concerns about your current investments keep you awake at night? With the market volatility we've seen in April, I think this is a really timely question for everyone to think about. If you are currently invested in the markets, and a majority of Americans do have some percentage of their wealth in the stock markets, has the investment performance kept you up at night any point this month? If the answer is yes, you might be in investments that are a little bit too risky. If you're looking at your actual performance, if you're just watching market headlines, that's different. But if you've been watching your portfolio and you're concerned with how it's invested and you're losing sleep, you might be in the wrong mix of funds for you. You make changes to your investment account every time the market drops. So for those watching, did you make any changes this month to how you were invested in your accounts? If you did, again, we want to revisit how you're actually invested. You might be taking on too much risk, and we might need to step back a little bit and reduce that risk exposure a bit. And then, do you monitor your account frequently? Are you logging in daily, weekly, monthly, a couple times a year? If you were logging in and monitoring your account on a daily basis, you might have a lower risk tolerance than others. If you're concerned in having to watch your account on a daily basis, you might be in things that are a little bit too risky for your comfort level. If it's forcing you to feel like you need to check in on it daily. There isn't a perfect amount of time to how frequently you should monitor. You want to be aware of how your investments are performing, but you want to sit back and know, okay, I purposely chose how I'm invested when things were calmer. I know I have my emergency savings. I know I can ride through this next wave, so I know I'm okay. So if you had, think about these questions for yourself and if you may or may not be in some of the right investments today. And then, of course, naturally, we want to be realistic with what we can expect from the markets. Also, because there have been some really large outliers in the last few years when we think of digital coins and digital currencies and certain types of high-flying tech stocks. Sometimes the expectation of what the market is going to return and investors' expectations are not realistic, or you might be taking on more risk because you expect to get X percentage back, which may or may not be actually realistic for based on the company and that investment. So recognize that investment markets, they gain and lose value in cycles. Every single one of us is going to live through some more market cycles in our lifetimes, most likely. And anyone who's younger in particular will probably experience 5, 6, 7 potentially market cycles in the years ahead. So it's natural. Even things like we've seen this last bit, market cycles are part of what works. It's also what the markets actually need in order to actually continue to grow up the other direction. We actually need the times where we do have corrections to stabilize the foundation for us to continue to grow. And then remember, of course, that if you use insurance products or insurance type of accounts, your return is going to be limited. Sometimes they do have caps on what they're actually going to earn. So be mindful if your investment vehicle is within an insurance product that you understand the ins and outs, as well as what you're paying behind the scenes, because oftentimes it's really hard to find. And then again, evaluate what you can reasonably expect to earn from those investments. And think about what is my return expectation? How much do I think I need to earn or want to earn on an annual basis? And are my numbers in line with what's realistic and what companies are expecting in the years ahead? So we wanted to add in a few slides here just to talk about some of the recent market volatility we've seen. Naturally, I think that's a topic probably of top of many people's minds right now, just given how volatile the month of April's been this year. And so this chart is really kind of showing the the gray bars are the actual return percentage of the S&P 500, where the S&P 500 ended the year. And the red marks on there are actually the low points it hit at any given point of that year. So you'll notice, and again, there's a lot going on here, but the key thing to take away is markets fluctuate quite a bit, and they can fluctuate significantly. If we look into I think that's 87 there, and the market was down 34% at one point, but still ended up positive 2% for the year for the S&P 500. And this is actually, in all the years listed here, 75% of the time, regardless of what was happening, the market still ended up at the end of the year. And 2024, it was down at one point up to 8%. It ended up 23%. So there's no exact guarantee of just because we've experienced some market volatility that means the end of the year and everything's going to be terrible and it's going to be horrendous. If anything, we actually often see the market bounce back quite a bit. And if you notice, some of these that have seriously far down red points, then again, the bar where the market ends at the end of the year is in completely the opposite direction. So that is part of the reality, but it also shows no one knows exactly where the markets are going to end, how they're going to do. That's why it's important to make sure you're in the right investments so you can withstand these periods of time, but also understand most of the time the market ends up more than most of the time. So a lot of it is just kind of in perspective of where are we today? Where are we in the market cycle? And then can we handle the volatility we're experiencing in our own investments? And all of that really points to the importance of staying invested. There's a concept that many of you, I'm sure you've heard about, market timing. And market timing is really when, if I was really nervous and losing sleep, and we understand if you're really stressed about your investments, it's because we know that money means so much to you, and it does for everybody. And it's really hard to see it moving around a lot because of what's happening in the headlines and in the markets. But the reason it's so important to stay invested and choose the right types of investment early on as you're getting going, or reevaluate over time, is because of the 7 out of the 10 best days, best market performance occurred within 2 weeks of the 10 worst days of market performance. And this is looking back from 2005 to 2024. So like the last 20 years, the 7 best days were preceded by the 10 worst days. So for market timing, that means you're trying to think, okay, well, I don't feel good about this. I'm going to change my investments. I'm going to take my money out of the market now because I don't like what's happening. I'm going to make changes because I'm uncomfortable with what's happening. Again, understandable. We're humans. Seeing our money, seeing us lose $5,000 feels a lot worse than it feels good to gain $5,000. That's just naturally how we're built. But the reason it's so crucial is if you pulled your money out even before some of the decline or towards the bottom of the decline, and you have to get the answer right or the question right on both ends. Where do I get out? But also, where do I get back in? Most investors, if they're trying to market time and they think they know or they just can't handle how they're invested, they will take their money out on the way down. But the challenging part is they don't know when to get back in, because no one can perfectly predict when we're going to hit that low point and the market's going to bounce back up. But if you miss that bounce back up, you've basically captured that loss. You've missed out on the hugest part of the upswing, and it's really challenging to actually gain back what you've lost, because now when do you get back into the markets again? That's why it's so crucial to keep your money invested as long as you can tolerate it as much as you can. But this kind of shows you, if someone that stayed fully invested over this 20-year time period, starting out with $10,000 in 2005, that $10,000 has turned into $71,750 in the S&P 500 without moving everything that's experiencing the great financial crisis, experiencing some of the volatility we've had these last 2 decades. They're up to $71,000. If they miss those 10 best days that were close to some of those worst days, their account's at 32,000. So instead of a 10% return, they're actually at 6.1. If they miss the 20 best days, their account's at 19,000 and change, up 3.5% when it could have been up 10 and 10.4. And so on and so forth. And you see, if you miss some of these other best days, your account's actually still negative for the year. And I've certainly come across people who did not reinvest their money after the financial crisis because they understandably were really stressed. They missed it. They missed the upswing, and they've never recouped that since way back when, because of just not being comfortable, not knowing when to get back in. So as much as it's difficult, please try to stay invested if you are invested. And a lot of that does point to diversification. So that's a term for basically spreading that principle, spreading your money between various asset classes. So you're not only in US technology stocks. You're in, potentially, and this is just an example, long and short-term bonds on the side here, large and small company stocks. And that's not just in the US, it's also international and maybe some of the emerging and developing markets in other countries around the world as well. So you want to consider a combination of potentially individual securities. So that could be individual stocks, but really mutual funds and exchange traded funds. It's going to give you a basket of securities that you can access. So you essentially don't have all of your eggs in one basket. And then weigh each new investment for the diversification it adds. If you have a couple different mutual funds or exchange traded funds, and you're, oh, great, this is great. I have a couple different kinds. I'm probably pretty diversified. But if you're not looking what's under the hood in those investments, they might all be just in US large cap or US technology, and you might be overexposed more than you even realize, just depending on what each new investment actually has in those underlying holdings. And look at it as a whole. How does it add to my overall diversification? Am I spreading the risk between asset classes, even some between countries? So we're not all just in one particular place. The US is still majority of the global market. So we're always going to have a large proportion to the US. We also often have a home bias, but there are quite a few other developed markets as well. So just in this last bit of time, international has actually been outperforming the US for the first time in a while. But again, there's no guarantee of what asset class is going to do the best at any given time. That's why you want to have a kind of a basket of that exposure, that diversification that's kind of spread out. So this is another slide on diversification in a portfolio, but also talking about how time kind of smooths everything out. So, and the reason we added so many charts is I think it's really helpful right now thinking about all of this market volatility and how do things stack up? Where are we? How do we feel about what's going on in the markets? And what are the most important principles for any investor today to understand and to know? So historically, when we look at, and this is just for the sake of example, this is growth of $100,000 over 20 years. So kind of that, but we're looking back between 1950 and 2024. So the last essentially 75 years of market performance. If we were 100%, so we're looking at 100% stocks, 100% bonds, or a combination of stocks and bonds. So 60-40, that really means 60% stocks to 40% bonds. Whenever you hear, oh, it's a 60-40 or a 70-30 portfolio, whatever number is first is the amount that's in equities or stock exposure. So on a 1-year period, stocks are generally more volatile than bonds, of course. Stocks returned anywhere from down 37% to up 52% in that 75-year window, just depending on the given year. Bonds, anywhere from down 13% to up 33%. And again, a combined portfolio that's 60% stocks to 40% bonds, down 20%, up to 34%. So a lot of volatility, a lot of ranges, a lot of potential outcomes of what could happen on any given year. But what's interesting is when we look out 5+ years out, how those numbers start to come together. So on a 5-year rolling window, your stocks might be slightly negative if you look at any given snapshot, but anywhere from between down 2% to up 29%. Same thing with bonds, down 2% up to 19%. But once you hit a 5-year time, and we're literally averaging out 5 years, or at any given point of time, rolling 5 years, we have not had a negative 5-year period for a combined stock and bond portfolio since before the 1950s. So even if times like this feel really stressful, markets historically, especially when you have proper diversification, we don't experience these. These are acute periods or shorter term periods of financial strain or stress, and we do get through them. And then once you get to 10 and 20 years out, those returns start to normalize and annualize and get a little bit closer. But the combination of what you're getting from a diversified portfolio is anywhere from 5 to 15% is actually pretty close to the overall stock portfolio of 6 to 18%, and you're taking on a lot less risk. So that's why having that mix matters, and having that time invested in the market really does matter. And this is kind of my last slide on diversification. Kind of a key thing to take away from these slides that I used from a different asset management company that has some great resources, which this is looking back since 2010. These are the various asset classes. So within the US stock market, there are a bunch of different asset classes or similar types of companies underneath each of the large markets. Who is going to be the highest performing, quote unquote winner each year is very much subject to, it's very much unknown, and it changes all the time. That's why this color chart is all over the place. That means 1 year, large cap was up the highest annualized, and a couple years later, it could be much further down. The reason we bring this up and we show this slide is to kind of point to this white asset allocation box. What this is a diversified portfolio in the middle. So even though there might be, there's some different asset classes in blue and purple and the various holdings, commodities, REITs, whatever else, emerging market, all over the place in different colors. The white asset class box here is actually a much smoother ride. It's a much smoother experience. And as a financial planner who also certainly works with clients and manages money, part of our goal is to have any investor have a smoother experience so that you stay invested for the long run. We don't want you to experience all of this volatility and these ups and downs. But because ultimately that helps you stay invested and feel comfortable when we do have these market cycles and volatility like we've been experiencing. So a little bit more on asset allocation, because we talked about that. We've talked about diversification, but what does that really mean? So asset allocation is part of that your investment strategy, and that's really, it does help you control risk without potentially reducing the return on your investments and on your portfolio. But that's really what we talked about when we talked about that 60-40, 60% bonds to 60% stocks to 40% bonds. That's really talking about your asset allocation. So what percentage of your assets are in the various categories or in individual securities? So you think about dividing the money you have among those various asset classes on a percentage basis. And then you want to have several asset classes at the same time. So stocks, bonds, potentially cash, alternatives, whatever the case might be, that what feels appropriate to you. Because again, all of that is helping to hopefully have you experience less market volatility while still having a really robust return in the long run as well. Because we noticed in those 2 slides ago or so, you didn't really lose out on return when you're combining. You're actually just helping to provide a bit diversification. Here's an example. This isn't necessarily something we're recommending, but a common one people might put together is, it's maybe stocks and stock type funds, whether it's mutual funds and ETFs. Maybe it's 65% and there's 25% in bonds or bond-like funds. and some portion to cash. 10% is probably high, but again, this is just to show you more of how that actually is structured. And then where you are on this, whether your ratio of stocks to bonds that we'll cover in here is really speaks to that your time horizon, again, the time until you plan to use or start using a bunch of this money or start needing to withdraw some of this money. And also oftentimes your age, time horizon, your age, and also your comfort or willingness to bear risk. So typically, this is not the case for everybody, but typically younger investors that have a long time horizon, if you're planning out, I want to start contributing to a retirement plan, I want to start thinking about saving for retirement or the money to set me up for the long term, even though I don't know exactly what that looks like yet, they can typically take on more investment risk. And we often will see those investors usually allocate more towards stocks than they do to bonds. They're able to bear the risk. They have the time to deal with any market fluctuations in the numerous market cycles. So they like oftentimes will have much more or a higher percentage to stocks than they do to bonds. And often, typically, as we see, as most investors, not everybody, but as most investors get older, either approaching into or well into retirement, over time, we do see that percentage of stocks to bonds shift. And oftentimes, as people are getting closer to retirement, we do see them start to tamp down the stock exposure. But again, what is the right mix is really a personal question for yourself in understanding your financial situation. It really is dependent. There isn't a hard and fast rule for everybody. It depends on what other assets you have, how predictable income is going to be in retirement, for example, and whatever else you have to fall back on, as well as your comfort. Because even if you can take on a lot of an equity risk because you have other assets or a large pension that's going to supplement your income when you're retired, just because you can doesn't necessarily mean you should if you're not comfortable doing it. And then again, typical. So as investors do get older, we oftentimes see them that shift again, that mix skews towards bonds more than stocks. But again, always exceptions. So think about it in context of what matters to you and how you feel about your risk. This is another chart we wanted to include, talking about, again, the power of compounding. If there's one concept I wish everyone knew and understood and appreciated from the time we were in school, it's how the power of compounding. This is looking at the growth of $10,000 over the course of basically 30 years. This is assuming, and this is what we talk about, why investing for the long haul matters and why getting started, even if you don't have a ton, but you start getting into the habit of saving $20 a week or a paycheck and trying to increase it over time, why this is so crucial for your long-term financial situation. This $10,000, if we were reinvesting dividends versus taking the money out, so let's just assume we're going to continue putting the money back into work for us. It's going to, as any income's generated, it's going to buy more shares. We don't really start to see this huge payoff for us until later on in life. It starts around that 20 to 30 year time windows when we really start to see that power of compounding, what that actually means, start to pick up. So this $10,000 in 1994 grew to $224,000 in December, as of December. This is in the S&P 500. If it was just with the price return and not reinvest in dividends, that grew to $128,000. But either way, $10,000 without any additional contributions from us or from yourself would have grown to $224,000 if it was just plopped into the S&P 500 in 1994, left to continue to compound over time. And that's nearing $250,000 from $10,000 investment. That's a pretty good deal. I think if we all look back of what we could have done differently a couple decades ago, how we could have invested money, I think we'd all be happy having a little bit more of that in our pocket if we just put the money aside. But this is why, again, having that time invested is so crucial. And then the bottom chart here really just goes to talking about the different types of asset classes. So oftentimes, a number of investors understandably feel uncomfortable with the stock market. How do I invest? I don't know how to do it. Where do I do it? What's the right way? I'm just not as familiar or comfortable with all of this. So what's the proper allocation for myself? You know what? I'm not even going to deal with this. I don't know what to do. I'm just going to leave it in cash. I'm going to leave it in CDs or short-term treasuries and call it a day. The reason, again, that doesn't mean that's not good to have a portion of that in there. Again, we talk about diversification. We talk about spreading our risk into different types of asset classes. But the reason investing for the long haul is so important and can be so important to most individuals is because with inflation, those treasury bills are basically just below inflation. That $10,000 would have turned into $20,000 with invested in U.S. Treasuries. Again, it's safe, it's stable, but it's not earning you anything. Whereas the part that was in the markets would have been $224,000. Inflation over this 30-year time period would have grown. So $10,000 in 1994 is actually the equivalent of $21,000 today. So inflation has been eating away at our purchasing power. So $21,000 today is the equivalent of $10,000 30 years ago. But same thing. So these are some corporate bonds. So these are bonds that would have turned into $61,000 if it had been invested in just corporate bonds. Large cap stocks and small capitalization stocks are pretty close. That's where that really high performance return came in. But again, you see there's more volatility along the way. But this is why you want to have a combination of the stocks and bonds. And you don't want to just be sitting in cash and savings, because you're not going to be able to earn this and get this appreciation for taking on the risk by purchasing certain investments. So we do think about choosing investments. Again, we want to identify the investments. They have the potential to deliver average annual returns. What historically has this fund or this company returned? And you don't just want to look back 1 or 2 years. You want to look further back. How has it performed? But you really want to do your own research. If it's a basket of stocks, so maybe it's a mutual fund or exchange traded fund, how has it performed historically? What is the kind of the mission, the stated mission or intention or investment philosophy of that fund? Are they just trying to access a certain part of the market, or are they providing inexpensive broad exposure? Pay attention to the expense ratios. If you are buying a mutual fund or exchange traded fund, you really want to be conscious of what the cost is, the fees involved for that company that is managing that fund on your behalf. And try to find, there are a lot of low cost options these days. So do your research. Again, if you work with a financial professional, consider working with a financial professional to make sure you're in the right types of investments for yourself. But again, choose among those that are suitable to that are going to fit into that diversification, that asset allocation plan, also something that you're comfortable with and informed about how you're invested. A couple things to avoid. We really want to, as much as it can be more familiar, oh, I'm going to buy this big name company that I've heard of, I'm just going to put all my money into that. To really do your best not to concentrate on just 1 or 2 of those investments, or even just 3. You really want to have diversification across a number of different companies or number of mutual funds and exchange traded funds as well. Because some of these companies, just based on what is happening, the headlines, news, whatever it might be, can really be volatile depending on what's the type of company it is. Then don't put money into investments you don't understand, whether it's someone approaches you with an investment or you're researching it yourself and you're not really sure what the strategy is or what the investment is. If you're not aware, you're not able to kind of research it and find out, you're not working with a financial professional that's explaining it to you, be careful to not put money, just make sure you understand how the money is invested, the intention of whatever it is, and don't put money into things you don't understand. Again, don't overload on company stocks. That also means it's actually pointing to your own company stock. If you're receiving stock or you have an employee stock purchase plan that's at a discount in your current firm or company, don't only purchase that or only have that. You don't want to have majority of all of your financial assets be just in your company stock as well. You want to think about reducing concentration, that concentration risk everywhere. Make sure you're fully diversified. And a key one, especially for what we've experienced the last few years, is don't chase hot performance. Well, if you see a stock that's all of a sudden in the headlines a lot, and we've certainly seen those in the last few years, or a certain type of investment, oftentimes what happens for retail investors is they will get in and buy those pretty much at the worst possible time. Oftentimes, then it starts to go the other direction. Maybe the institutional money is already out, but be really mindful if you're hearing about something or you're hearing about something on Reddit or whatever else, just be really careful that you're not trying to chase performance, because there's no telling that there's no reason necessarily that's going to continue to have that hot performance. So just take your time as you're making these decisions and make sure it's part of your overall plan when you're choosing to invest your money. So the approaches that do work, start investing early. Easier said than done. Certainly something we're conscious of, right? It's not easier said than done. We'd love to be able to have all started to 10,000 and when we reach 20 and it's turned into $224,000 already. But even if it's not a huge amount of money, start getting to the habit. It's the habits in the long run that end up creating wealth. It end up creating a lot of financial security and stability later in life. So start investing early. You don't have to do everything all in one lump sum. You can start investing regularly and automatically set up automatic transfers from your checking account after you receive your paycheck into whether it's an IRA, an individual retirement account, or a taxable account for yourself. Start getting into the habit of having that automatically go to work for you behind the scenes. You can also dollar cost average in. So if commonly when we've had these historic market returns and markets at all-time highs like we often see, a lot of investors don't feel comfortable necessarily putting all their money into the markets because they keep hearing the market's kind of expensive, the market's at all-time highs, I don't want to lose money. So what some investors choose to do is actually dollar cost average. So whether it's a percentage of amount, a fixed amount, maybe it's I have $10,000 I want to put to work at some point this year or in the next time frame. You can say, I'm going to put $1,000 to work a month, on a similar day and just kind of start putting that money in. So regardless if the market is up 10% or it's down 15%, you're actually averaging out what your entry price is. Or some people choose I'm just going to start putting 10% of that, whatever money I have available, 10% of it's going to be allocated on a regular basis. So that's dollar cost averaging. And I mentioned direct deposit from your paycheck, but the most important approach that works is honestly, and hopefully that's kind of come through from the presentation today, is staying in the market. We will recover. Whatever does happen, we always recover. Even though it doesn't feel like it, sometimes it's important to take a deep breath. Know we're going to be okay. Think back to your plan and your strategy and ensure you're moving things forward for the future. But stay in the market as much as you can. Try to hold on to where you are. And again, here's another quick example of $10,000. If we were averaging 7% instead of the 10.4% or so that we've experienced historically, because that does feel frankly high. Most of us don't anticipate we're going to have 10% returns in the foreseeable future on an annual basis. But let's say it's around 7%. So that 10% today, if we think about time value money, the power of compounding, 7% in 10 years, that's 19,000 without any additional contributions. In 20 years, that 10,000 has turned into essentially 39,000. And in 30 years, that 10%, or excuse me, that 10,000 has turned into 100,000. So that's also too why, as much as we can, save and invest today for our long-term future. We're going to be happy we set aside that $10,000 30 years ago. That's now had 10 times the return. Now it's worth 100,000. So when you do manage your investments, I mentioned this briefly, but pay attention to those investment expenses. If you are buying mutual funds or exchange traded funds, be conscious of taxes. If your money is invested in any sort of taxable brokerage account and you do have a great position that's done really well, once you do sell that, you'll have to pay taxes on a portion of the gain because the money wasn't taxed, during until you actually sell it. But do not let the tax part dictate your actual investment strategy. You don't want to be stuck because of the tax picture. Oftentimes, some investors don't kind of what we consider rebalance or move those investments because there might be a taxable event. Totally understandable. But if that position has become a really large part of your portfolio, then all of a sudden you're subject to more concentration risk. You might have more equity exposure than you intended to. You might feel like you're kind of stuck. So don't let just the tax side of things dictate your investment strategy. That should be secondary. Monitor your investment strategy, just like anything else. Keep on track on occasion. You don't need to check it daily, but see how it's doing over time just to make sure you're on target for what those goals are and your risk tolerance and your time horizon. Again, rebalance your portfolio as needed to keep it in line with that asset allocation. So if you were getting started and you said, I'm younger, I'm more comfortable, I want to have 80% of my money go into stocks because I'm not planning to use this money anytime soon. I'm planning for this to be the future. 20% is going to be in bonds. Over time, if those stocks perform really well, you'll see that equity, that stock side start to grow and grow and grow and become larger part of your overall asset allocation. So on occasion, you need to rebalance and shift things around to have it still match what you want it to be. Again, those plans are going to evolve over time. So revisit your plans. So these are specific things to think about of, when should I adjust this? If your goals change, again, if your preferences, if your risk preferences, or your goals for your return, for what you want your portfolio to return are going to change. If there's a health event, if your financial situation changes, maybe you had to retire early, or you thought you were going to work for another 10 years, you can't anymore. That might certainly necessitate shifting your investments. The economic situation changes a lot, and you want to think about taking your foot off the gas, or potentially looking at investments that are going to produce more income. Or if you become a more experienced investor, you might be able to access or be comfortable investing in different types of investments that weren't as comfortable or familiar in the past. So again, when you look forward and you look ahead, again, investing, as we say here, is a voyage of discovery. None of us know exactly what's going to happen, which is why we want to choose the right structure and right strategy now, and then again, make changes over time. But again, if you do make a mistake, we're human, it's going to happen. Individual mistakes are not fatal. You can recover from all of this, but that's why you want, again, just to try to stick to the plan whenever you can, but don't beat yourself up if you're getting started later, or you've made some mistakes in the past. We all have, and that's just part of how it is. We're all going to experience many market cycles during our lifetime. So go with it, go with the flow, try to stick it out, and then again, learn from your experience. That's a crucial part, is what did I do in the past that worked? Stick to a disciplined strategy, and you're going to be fine in the long run. So there are certainly professional expertise can help you make those decisions if need be. Then again, of course, there are a lot of resources available online, but understand your situation is unique. So you want to be thinking about all the advice you're getting in context of who you are, what you have, what matters, and your comfort. It shouldn't be just listening blindly to anything you're reading or hearing from someone else. It needs to make sense within the context of yourself and what you care about in your investments. But ultimately, you're responsible for your investment results. So make sure you're taking some time to select the right types of investments early on, so that you feel comfortable sticking in them in the long run as well. A couple books or two here that we wanted to include in case people want to look for additional resources. So Stay the Course, The Story of Vanguard and the Index from John Bogle, or Little Book of Common Sense Investing, as well as some other Morningstar Guide to Mutual Funds and other resources. There's so much available online about just successful long-term investing principles. So definitely take a look through, and let us know too. If you do have questions or you're looking to get help, you can always look at Planner Search if you're looking to hire a certified financial planner or some sort of wealth advisor that lists qualified planners. You can look by location, specialty, their fee structure. You should get a free consultation from anyone you speak with. You can look in a certain demographic area, and also provide you lists of questions to ask so you understand their compensation, you understand where they specialize and their experience level. But always, if you're ever going to work with a financial professional of any kind, make sure you go to brokercheck.finra.org to check their record, and also check for any red flags that could be on their record as well. So make sure you're protecting yourself and your money. But with that, if there are any questions, I'd be happy to answer them. And hopefully that was helpful. And hopefully everyone understands too, this period right now of market volatility, we think we're going to have some more volatility for a while, but we're all going to be fine in the long run.
Thank you so much, Jamie. Let's get to the questions. I have a question. With all the recent market ups and downs, how do I know if it's a good time to invest, or should I wait?
That is a good question. Yeah. This is part of the reality. We think with what we're experiencing right now, there's never a perfect time to get started. If you're sitting on the sidelines, the most important thing to do is actually just start to dip your toe in and start to get that money working for you in the long run. So even with the market downs, these actually can be certainly buying opportunities. The market has repriced some of this. So it's important to start allocating that money, investing for the long run, so you can start to take advantage of that power of compounding, like all those charts we showed. And again, now there's never a perfect time, but if you have money sitting on the sidelines, think about something like dollar cost averaging and putting in little chunks of money to start to work for you in the background, and make sure you're comfortable with how you're invested.
Okay, perfect. Thank you, Jamie. Also, what was the difference between investing and gambling? How can I avoid taking on too much risk without realizing it?
Yeah, it's kind of a common analogy, right? Investing is kind of like gambling, because you could lose your money. It's true. There's no guarantee when you're investing your money in a company or a basket of mutual funds. You are it is an investment, right? There isn't a specific guaranteed return you're going to receive as a result of it. So it behooves us to understand the specifics underneath the security of the company or the basket of companies that we're investing in. But it's not the same as gambling. There are certain types of asset classes or certain types of securities in this day and age that I'm not going to name that can certainly be like gambling. But for majority of the investing universe, it's not. But you want to be mindful of it. You can certainly be things that are very safe, conservative and pretty stable. Safe is air quotes. But how can you avoid taking on too much risk, which is a good question. You want to think about what kind of company, if you're buying a single company stock, what kind of company is it? How large are they? What are the fundamentals of that company? Do they return a bunch of dividends? But if you're in a basket of mutual funds or exchange traded funds, if you do even a quick search on the ticker or the CUSIP, what the fund is called, you'll be able to very quickly find what are their top 10 holdings, what type of investment is this, so you have a better understanding of where it falls in the risk parameter. But you just need to do a little bit of homework and you can figure it out. But it's a great question.
Thank you so much, Jamie. Also, how do I decide on the right percentage of stocks versus bonds? Is there a way to decide?
Yeah, it's hard. It's based so much on age, risk tolerance, comfort with risk, that time horizon. But in general, if you have a goal or the intention of this account or part of the money is to fund a goal that's pretty soon, the next couple years, you should not have that in a lot of, in general, you should not have that in a lot of stocks. A lot of that proportion in stocks, because you just don't know exactly where the stock market will be at that given time in a year or 2 or 3 years when you need to access that money. If your goal is farther out, 20, 30 years down the line, then absolutely it's okay to have more stock exposure, but it needs to be in context of what we're comfortable with.
Okay, thank you. I have one more question. How can I build a portfolio if I don't have a lot of money to start with?
Yeah, so if you don't have a lot to begin with, the key thing is getting into those habits, starting to set up automatic transfers, whether again it's $10, $20, $50 a month or a week or a paycheck. Start having that go automatically into a kind of open up a taxable brokerage account. Start playing around with what does it look like to invest this? How do I actually do this? How do I buy in any of these companies? And figure out a kind of a mutual fund or one fund that has broad exposure that you can start with. But you can, even if you don't have a lot to start with, it's the habits, it's getting into these habits that are going to help you really build wealth over time.
Perfect. Thank you so much. Now we're at time, so I have to stop. So thank you for a great presentation, Jamie. Lots of great information as always. If anyone missed any part of this presentation, it will be available for viewing shortly on LAPL's YouTube channel, youtube.com/Los Angeles Library. I want to let everyone know we also have one more Financial Literacy Day event coming up, Saturday, May 10th at the Palms Rancho Park branch. During this event, individuals can make one-on-one appointments for free private consultations with certified financial planners. All the information is there on our Financial Literacy Month webpage, lapl.org/Financial Literacy Month. And thank you again, and have a great rest of your day. Thank you. Bye-bye.